most people believe I'm a real estate investor because I have a primary residence. That's actually not an investment. Sure, you're paying down on your debt, your mortgage, you're having that appreciation and everything, but an investment is something that's going to give you a yield off of it.
Welcome back, everybody, to another episode of The Pursuit of Purpose. My name is Chris Kiefer, and today I am with Julie Hawley, who is the host of the Conscious Investor podcast and the founder of 3 Keys Investments. Julie, I won't try to explain any more about what you do, so I'll pass it over to you. First of all, thanks for coming on. And second, I'm really looking forward to the conversation today.
Well, thank you. I'm really excited to be here, and I'm excited for your episode going live on the Conscious Investor podcast. So it's always super fun to swap podcasts. So obviously, one of the roles I have in life is podcasting. For over 400 episodes deep. So it's something I'm very passionate about because we can learn and grow so much just by listening, which is why you're listening, right, listener? I love investing specifically in real estate, and made a pivot after 20 years of investing in real estate in the single family space into large commercial real estate assets,
That's
apartment
awesome.
complexes specifically, and I love it. But most importantly, I love that I have a company now that brings other people into those investments so that they can have the joys of owning real estate, not REITs, but real estate without any of the headache.
So that's super interesting. In context, I'm in a group here in Coeur d'Alene called Man on a Mission. You were connected through a couple different people, but you had seen through a post and saw my podcast, reached out, got connected. So yeah, I was just on your show, or we recorded it last week. Great conversation. And then I found out that you're also connected with a good friend of mine, Anthony Walker, who's been on my show, and he's one of the co-founders of Cornerstone Investments. And so I think this is a super interesting topic because it's something that I'm diving deeper and deeper into and just trying to learn as much as I can. So I would love for you to give like some context of the different levels or the ways to play the game of real estate investing. And I'll start it with my current baseline understanding, which is for a general person, you can go buy a house, a single family home, and you can rent that out. And now you're a real estate investor. You could, I guess technically owning your own home would also make you a real estate investor, although that's your primary residence. Obviously, you're not making any cash flow on that. The other thing you could do would be find a duplex or quad or whatever multi-door property, which is a kind of a level up in my opinion. And then you get into doing I don't even know if I'm using the right terminology, so you can correct me. But there's syndications, and then you're collectively compiling money and then buying larger either apartment complexes together. That's my understanding. I don't know any of the terminology, but I know that this is something that I want to get deeper into because I believe in the benefits of spreading your money around in the different types of investments that are available to us, because there's pros and cons to investing in mutual funds and the economy and the stock market and businesses versus real estate or yourself or any other investment you could make. So if you could give us, building on my poor description, tell me what is possible and where you guys fit in with 3 Keys Investments.
Your description was really great. It was like, most people believe I'm a real estate investor because I have a primary residence. That's actually not an investment. Sure, you're paying down on your debt, your mortgage, you're having that appreciation and everything, but an investment is something that's going to give you a yield off of it, right? So we don't categorize personal residences as an investment. But when we start thinking about investments in real estate, I started in the same spot that most people do. Well, I actually started house hacking, which means I was renting out a room in my house to offset my mortgage. But a lot of people think that I have to invest first in a single family home, just a regular residential house in a neighborhood somewhere. And then I can graduate and I can go into small multifamily like duplex, triplex, quad, something like that. And then once I've done that for a period of time, then I could start thinking. Like, we kind of, in our minds, I've spoken with so many investors, we categorize these things as if they're sequential and progressive, and we have to do one before we do the other. In all reality, you can bypass all of the headache of having a single family rental property, and you can skip all of that and go straight into the multi-million-dollar, investment space. Most people don't realize that they can do that because they're like, oh, I don't know enough. I need to do this first. I have to build this up. And so it's changing our mindset to understand that, one, it's not sequential, and we can move into this other space through the syndication model. And syndication is a fancy word for something that most of us have done. So, listener, think about this for a moment. Consider, have you ever pooled your money together at the office or with friends to buy a pizza, buy a gift, or, do something of that nature? You're syndicating it. It's like you're all going in, you're pooling your money together to accomplish something bigger than what you could do on your own. That's all we're doing in the real estate space. And that gets like super exciting when we're talking about multi-million-dollar purchases. The returns are substantial. So even though we only own a portion of that, let's say your ownership share, if you invest $100,000, in, this $20 million asset, your ownership share is going to be very small percentage wise, but you're more than likely going to come out ahead than if you would put that $100,000 into a single family, like on it as a down payment on a single family home. I'll pause there.
Yeah, so I'm wondering, or one of the things that I'm, again, this is probably common in your world, but something that I have or becoming more aware of is the equity that you have. So we have a rental property in Coeur d'Alene. The equity that we have in that property is the cash that we are choosing to invest in that particular vehicle. And so a lot of times people will, the at the time that we bought it, the equity was not what it is now, right? So there it might have been a good investment at the time, but depending on the value of the property, there's more cash sitting there that you need to be calculating what type of return are you getting on the actual cash that you have available. So then the question is, do you want to refinance it or sell it and then take the additional cash and go put that to use somewhere else? So I'm assuming that when you, and again, I guess I would be curious to know a fun way of asking this question when we're talking about like the return on a syndication type of investment versus a single family home. What's the worst? This would be, again, you can tell me if this is a bad question or you can answer it a different way. What's the worst syndicated real estate investment deal that you've been a part of as far as a return goes? I guess it could be zero or you lost your money. But aside from that, what would it be?
Yeah, no losing money. Yeah, I haven't lost money, made a lot of money, made more money in the syndication space as a passive investor. So in this space, we have two different types of investors. We have passive investors or limited partners, and they're just simply deploying capital, putting their cash into the deal. And then we have general partners or active investors who are actually running, managing, sourcing, like so sourcing, asset management, securing the loan, taking care of risk capital, like on the general partner side. So I invest in both capacities. And on the limited partner side, definitely every time we receive a distribution, which is quarterly, it's like, this is so much better. We did really well on the single family side of life, just owning, single family. I'm not having to do anything, and it's coming to me. It's directly into my bank account. I didn't have to worry about, is a tenant going to renew? Is this going to happen? What needs to be done? I don't have to think about anything and
Mm.
just have these distributions because general partners are taking care of that and running the show. So some of the concepts to think about, this opens up like a whole host of things, right? Is understanding what your investment goals are. And so you want to evaluate, am I investing because I want that cash flow right now in my bank account, Or am I investing because I am just, placing this as a hedge against inflation? I am investing for, down the road in the future. In either capacity, I always encourage investors to consider. Um, I put it like this: like distributions, I have seen not for our investments, but with other investors and investment groups, I've seen some of those distributions get paused, right? And so, depending on how that property is being managed, run, and people, how much cash is in reserves and what the economy is doing, the active partners could actually choose to pause distributions or reduce distributions. So it's really important to know, like, do I personally have the reserves of my own if that cash flow did not come in? You want to make sure, and then you want to make sure, like, who am I investing in? How confident am I in that their investment thesis? So some people, they're going to look at the blue sky and they might present blue sky to their investors, like, oh, it's all great, it's so great. Like, no, no, don't invest with anybody that's looking at the blue sky. You want to say, what's the worst case scenario to the nature of your question, and then what's the realistic scenario, and where is the harmony between
Mm.
those two? Show me how you try to kill this deal and it still made sense. So for us, along the way, if we can't see the metrics, we have a baseline metric that we go off of. Like if we can't accomplish an average of a 15% average annual return, or we can't average, let's say, a 5-6% cash on cash return, or we cannot come close to doubling our investor capital over that 5-ish year hold period, that deal's already dead to us. And when we're looking at that deal, and this is just going to be a little a little more detail, a little more granular, but I promise you, listener and Chris, this is going to serve you well if you go down this path. You want to look at what is their thesis when they're looking at rents. Are they expecting rents to continue to climb at an exorbitant rate? A lot of people forget that rents do go up and they go down. I'm third generation in real estate, and so I'm like, I remember these conversations, right, taking place. And so, you understand rents are going to go and they're going to swing both directions. So what is the thinking behind their rents? What is the cost of capital? What kind of loan? Is it a fixed rate loan? And is that loan going to have the runway if worst case scenario happens and we can't exit out of this deal, which means that's our way of saying sell it, right? If we can't exit out of this, is there enough runway on that loan that will get us into a safe, that will buy us some years even? So we want to double it. If it's a projected 5-year hold, we want to make sure that we actually have a 10-year runway to that. Because now, okay, within a course of 5 years, you're going to figure something out. But now you don't have to make that fire sale. You're not in a compromised position. You're not knee-jerk reacting to what's happening. And that's what we're seeing happen real time right now. You're seeing a lot of people having to navigate. They have these bridge loans, they have adjustable rate loans. We saw that in, leading into the '08 crisis in single family housing. Now we're seeing that on the commercial side of things.
Mm.
Lots more I could say, but I'm going to pause right there because I'm like, I don't want to go too granular because it's my favorite topic.
Yeah, that's awesome. So based on everything that I'm understanding what you're talking about, the if we could go back to the different, so obviously you said early on, having a primary residence that you own and you're paying a mortgage on, that's not an investment. So now we're talking about a single family thing that comes with headache. You got to manage it. Maybe you find a property manager, but ultimately that's still like, if there's issue with the property manager, you got to find a new property manager. Now then you're talking about you can do syndications. What I do know is that there are certain syndications that are only for accredited investors, which are individuals that have a net worth over $1 million, or if it's you can correct my facts here. If you're single, it's over 200,000 in income 2 years in a row, and if you're married, it's over 300,000 household income 2 years in a row. That's what allows you to be a accredited investor, which just opens up the doors to more opportunities because they're assuming that you are going to do the vetting yourself and, not get screwed, for lack of better words, because of not understanding what it is you're investing in. That's the idea behind the accredited investor term and the whole thing. Is that correct?
That is correct. And one of the things they also want to ensure is, a level of education, level of sophistication, and they don't want people being predatory and going after people who may not have the resources to lose. So that's one thing when we're speaking with investors at our company, we like to understand what is the financial positioning of our investors, because the SEC, Securities Exchange Commissions, like they can come down on you pretty hard if you're taking somebody's last, $150,000, whatever it is, right? For an investment, it goes sideways. That could be a big problem. So it's really looking at that financial health of an investor.
Because I would say when I heard the term or just the accredited thing, this was probably 5 to 8 years ago. I heard someone tell me about this accredited investor, this status that you have to achieve, and I heard the argument against it was that it basically was, again, or this one person that was telling me said he wasn't a fan of it because he thought it was just another hurdle for people to have to jump through, and it was just it's a hurdle that the wealthy have already surpassed, and they have all these opportunities. But if you're up and coming, it just is an added thing that you have to overcome. I feel personally like, because of the access to YouTube and podcasts and the way that you can learn so easily in today's world versus whenever this rule was created, however many years ago. I don't know if you know that. To me, it seems like and I've heard rumors that they're potentially talking about allowing people to take a test to pass the test and to become an accredited investor, which I would personally be a fan of. But aside from that, I don't know if you have any comments on that. I am curious. So now you're telling me if I'm above a million in net worth or I'm an accredited investor, I've got these opportunities, but you're doing something for people that are under that net worth, that are maybe, again, it sounds like you're doing something that is not required of companies like yours, which is making sure that this is a wise investment for the person who you're taking the money from, correct?
Correct. So yeah, a little bit of my own personal thought, my own evolution on my thinking. I used to think along the same lines. It was frustrating. I am very much into a smaller government, and I like, more control for people to make their own choices. However, as much as I love that, I'm also seeing things taking place in the investment space that does cause for concern, right? There are deals that go sideways, and those investors were told all the blue sky of those deals because, and I'm going to say something that's very probably won't be received well by a lot of people because of you. This is going to be controversial because this is my own opinion, obviously, because of YouTube, because of podcasts, because of self-published books, etc., etc. We have such access to information, and then we have a lot of very successful professionals who have entered into the investing space, specifically the commercial investing space. They've developed platforms. I'm not pointing fingers at anyone. I'm not calling anybody a bad person. I'm just saying it's become very easy to become involved in real estate, in commercial real estate, in syndications, in funds, in all sorts of elements that receive other people's money, but they don't have the experience. So maybe they've even, run multi-million-dollar accounts at their company. Maybe they've even had a team of people that they've managed. And so there's a natural inclination to say, I've been successful in this way. My success and my skills and my ability are transferable into whatever I do. And yes, I agree. Skills and everything are transferable. However, there's a type of experience that we lack. So, I remember stories of real estate literally my entire life. That's a big topic of conversation, right? And I remember the ups and downs of real estate. There are some things that you just learn innately because you've been exposed to it, you've been around it, you've been immersed with it. And so you know kind of how it operates, right? It, in this case, being real estate, but whatever industry a person is in, they're going to understand it and they're going to be able to build on that. And so, with that, we're in this new climate where you have a lot of people that got in. It's like, wow, this is great. I'm going to leave my job. I'm going to have the freedom I'm looking for in life. And I'm going to syndicate and everybody's going to win. And then you have deals going sideways. So, with that, I think as I've been watching things shift over the last year and a half, it's caused me to pause and say maybe there is some merit to having some of these benchmark hurdles so that people aren't just looking at the blue sky.
Yeah, yeah,
Even passive investors saying like, "Yay!" and they lack the education.
yeah.
And that's why. So we operate. There are two different ways that we can operate. There are actually lots, and let me clarify also. There are lots of ways to become an accredited investor. You can even take a Series 7 test and become an accredited investor. So the two primary ways are the ones that you express, like how much income you have or what your net worth is, but there are actually several other ways that you can become an accredited investor if that's something you want to do. The benefit, since we're talking about like accredited investors, let's think about what are the pros of it. Well, the pros are people can advertise their investment opportunities. So they can go and you can see on social media and on TV commercials, whatever it is, they can actually advertise like, hey, come invest in help purchase this 384 luxury, multifamily complex down in Dallas, Texas, let's say, right? They can advertise that and just receive investors immediately. The other way, which is how we operate, is there has to be a relationship in place first before that investment is placed. And
Hmm.
that's called 506B. And I like B because I say it's better. It allows everyone to be involved. And quite frankly, I don't want to have investors in our company's investments that are strangers to us or that we really don't know. Our goal is really to truly serve and support people in growing their wealth. If we want to do that, we need to understand and have that conversation. What is your goal? What are the resources you currently have? How can we work within that? Wow, maybe we should roll over your 401k and you can sample this investment without putting in your savings from your account that's in a special account making 5% right now. Like whatever it is. So let me pause right
Yeah,
there.
no, I think that's I didn't know about the Series 7 thing. That's interesting. And so that's another route that someone that is very to your point of like it already does exist. If someone is adamant about becoming an accredited investor, they can go through this test or study for it, take the test, and then they're accredited, correct?
Yep.
And then the alternative would be to do this. Did you say 506B?
506B. And so what that means is that you're going to have to go in as an investor and you're going to have to basically knock on the door of companies. Now, here's what I have noticed has happened in my years of investing in the commercial space is that oftentimes people start with what we call friends and family as their investor base and they grow from there. And I've noticed that as a lot of these investors start and they start to grow, they go from being this 506B offering that is, oh, you got to know me first before you can come into these deals. As they grow, they're like, we're going to start advertising and we're going to shift to a 506C. And so now this opportunity, even some of their investors might not be able to invest with them any longer because they've shifted into this accredited investor only status.
Hmm.
So it's about getting to know, it's networking, getting to know operators, sponsors who are active and who do receive and operate under a 506B umbrella.
Hmm. That's what basically because there's limitations on how many people can be involved in a particular deal with 506B, correct?
It is interesting. So you can have 35 non accredited investors in a 506B offering. And you can have as many accredited investors as you want. So here's an interesting thing that you'll find also taking place is that some people say, golly, I just like why is the minimum investment 100,000 or $50,000? Like, why? And a lot of times, as teams grow, they will raise their minimum investment criteria. And so some people will ask me, like, why isn't it $25,000? I only have $10,000. I want to get started. And we have to look at, in any investment, okay, well, we've got 35 slots available, and let's just say we have $7 million that we're bringing in investor equity to our deal. We won't have, we really want to open up those spots to sophisticated investors. Highest is going to win out on the sophisticated investor side of life, because we do have those limited spots. But the behind the scenes also that a lot of people don't take into consideration, and it's more on the maintenance side of things, is it actually increases the costs of everything. So you now have extra tax reporting that you're doing, you have other communications that are going on. It is a higher level of effort. So anytime you see somebody operating in this way, and even if they have a lower minimum investment that allows more investors to come in, you need to slap them a high five, because they're truly serving a lot of people. And it would be a whole lot easier if they just said, we're just going $250,000 or more. That's how you're getting in, right? Like they could do that. So the more
Yeah.
investors you have,
I was going to say that to me immediately, I was thinking like, of course, if if you're having to, you're in relationships with everyone that's involved in this thing, would you rather, have to keep 10 people updated and up to date and run all the tax reporting and everything that's required, or 100? Like there's clearly complexity and just time and effort and energy to the smaller that dollar size that you're accepting. It's almost like, what's the cutoff? Where is it even worth the time of the person in the business that has to, you know, uh, stay in contact with someone? I'm going to exaggerate, but if someone's investing $500, is it even worth the postage for all their notices? That like there's definitely a threshold, and the
yes.
larger the amount, the more, the simpler it is, from because it's, I'm assuming it's complex enough with just like running the deal and making that a success, and then the most controllable complexity dial that you could turn would just be smaller number of investors, larger dollar amounts. It's the same end goal, but now we've just eliminated that like headache or potential for headache.
Yeah.
When we think about those minimums and having, a whole bunch of investors coming in with, say, $500 or $5,000, right? We've talked about how that's going to increase just the maintenance, the communications, the costs of everything. There are people who, for many, many years, have actually joined together with friends and family, and they've created their own LLC, and they have, pooled money together to make those minimum investments. And so there are workarounds if someone was like, oh, I want to get started, but I only have 20,000 and the minimum's 50. Maybe you rally and you find some other like-minded friends that like trust, that you would trust very deeply, and you could pool together, form your own LLC, and then invest into a deal and split things up yourself. There are platforms out there that actually help individuals accomplish this and offer transparency, so that you can all see the bank account. It takes care of separating the taxes so that everybody gets a fair share of their depreciation and elements like that.
Ah, okay. Um, that's or another thing related to this, something that this is just relevant for us, is timing. I was talking to our accountant, and he was talking about real estate's great, but it's like timing is huge with everything, of just like, what year are you going to depreciate? What depreciation schedule does the investor choose, and all that stuff. And all the limitations and requirements around how and when you depreciate things. So I'm curious, when you are working on, like, if you're putting together a new deal, do you have, for you guys in particular, is there overarching strategies for like how and I should also clarify that I'm like the understanding depreciation and how that affects taxes is like at the cusp of my knowledge. So I will say my understanding is if I owned, $1 million apartment complex myself, I was the sole owner. Obviously, if there are improvements that are made to it, or the total value of the property, I can depreciate over a certain number of years, and then I can take the whatever the for simplicity, it's $1 million. Let's say I depreciated it over 10 years. I don't even know if that's possible, but $100,000 a year, I can reduce my gross income by that number. My question is, whatever you can put in real numbers if that is helpful, but if you were with a group of 10 investors that were depreciating that $1 million thing and there was $100,000 a year, is it literally just each investor gets, if we were all equal partners, everyone would get $10,000 per year that's depreciated? Is that correct? Or is there another, like, is any of the depreciation lost in the way that the deal is structured? Am I saying that clearly?
You're totally you're like yes, you're saying all of that in a really great way, and then let's just add a little more shape to this, right? So yes, the depreciation is split proportionate to whatever someone's investment is. Now, I'm going to say a little, I'm going to kind of go on a soapbox on this topic. Before I do that, what we like to do and what we have been doing is we've been taking bonus depreciation. So we do is we have a cost segregation study done on our, real estate asset, and they depreciate everything that would normally be on that 27 and a half year straight line depreciation, the sprinklers, the light bulbs, the roof, all of these little pieces, they're all getting depreciated, assigned a value, and then they're being depreciated year one. And in doing so, up until this year, you've been able to take for the last several years, you were able to take 100% of that depreciation in year one. Now think about this. Hold periods for the last, let's say 10 years or so have been somewhere between 3 to 5 years. So you know that you could take all that depreciation right there up front, year one. Whatever you don't use, you can roll it over. It's a simple form. I'm not giving advice and I'm not a tax consultant, but there's a simple form. You just file in with your taxes. So if you cannot use that depreciation, you can roll it over year after year until you've used all of that depreciation. Now, here's the important thing that people don't understand. If you were invested passively, okay, let's say you decided I'm not going to invest my $50,000 as a down payment onto a single family home. I'm going to put that $50,000 into a large multi-family, multi-million-dollar investment. You are now a passive investor. You have two different income buckets. You have a passive income bucket and you have an active income bucket. And if you're a regular W-2 employee, you can't commingle those. You can't just put something from one bucket into the other bucket. And so there are a lot of rules and regulations surrounding how that depreciation can actually be utilized. This is something where I think there's been a lot of miseducation out there in the investment space. Everybody goes around saying, depreciation, yay, yay, yay. And it's like, but can you use that depreciation? Most people have to be, have multiple passive investments. Now that's going to be really handy. Let's say you have a second passive investment and your first one sells and now you have an influx, you've doubled your money, right? And so now you have this influx of capital that just came your way. Well, if I have this depreciation, I can just offset that. But the other important element here is that we're offsetting, deferring taxes does not delete taxes. So there is recapture involved, right? So a lot of times people say defer until you die. It's really important. Again, I'm not giving any tax guidance to anybody, but this is why it's so critical to have a tax strategist or advisor, if you want to call them that, not someone that is not just simply filing your taxes each year, but someone who is being strategic with you in your plan so that you understand, okay, this is what I'm working with, and you're checking in throughout the year. Oh, hey, they've decided. Like, for example, we are going to be selling one of our assets in Iowa. Okay, we're letting our investors know that right now because I know that those investors are going to want to talk to their tax strategist so that they can already start planning ways for when it sells, how they're going to, mitigate that influx of capital to them. I also know they're going to redeploy it, and that's going to help them out a lot.
Well, I just think that's super fascinating. We're definitely getting, Natalie and I are just beginning to we're diving into the tax strategy and talking with people. And I do feel like it's just another one of those things that you have to learn about or understand. Otherwise, it's a missed opportunity to deploy the money that you are able to earn in life effectively to accomplish whatever goals you have. So that's real
Hmm.
super interesting. I love the way that you described it and broke it down, and just some good things to think about. Looking at the time, I want to move to the last couple questions that I ask everybody. First one is, what are 3 book recommendations that you have?
All right. I am a book. I'm always obsessed. So my first is always going to be whatever book I'm currently reading. So right now I'm actually on a book launch team for John Acuff's book called oh my gosh, All You Need Is a Goal. Fantastic book. I am loving it. I'm halfway through it. It'll come out September 12th. I'm not sure when this will air, but highly recommend get yourself a copy of it. I love this. If you're not a reader, I'm holding this up if this goes out on video. It's called Managing Oneself. It's like the size of a hand, it's really thin. I read it in 90 minutes with a pina colada that my husband made. Fantastic. It's by Peter Drucker. It's one of his essays. Everybody should read this. If you have high schoolers, they should read that book. And another book everyone should read, you can see it's all tabbed up. This is called The Motivation Manifesto by Brendan Burchard. Every person should have that in arm's reach. It will give you fire to really continually improve your life and well being.
Awesome. And favorite movie?
Favorite movie of all time? I'm not a huge movie person per se, but I would say I really like the Star Wars side stories. I really like all of the new ones that have come out. The one with Han Solo, and I think it was just called Solo, but I love all of those because it's like sharing this intricate background of characters that I fell in love with when I was young. And it was like, oh, that explains so much as to why you act and behave and respond the way you do. So
Hmm.
I'm just gonna go down anything Star Wars, but I really like the new ones with like the backstories.
I was so stoked when Lucasfilms got bought out because I was like, now we get to have more Star Wars twice a year. There's going to be a new series, a new movie. Because yeah, I'm a big Star Wars fan. And then the Star Wars land at Disney World and Disneyland is just unbelievable. We just yeah, our family are big fans of that. So I concur
Nice.
with you there. If someone is interested in learning more, or getting in touch with you to pick your brain or see what other type of investments you have going on, what do you recommend as the best way for people to get in contact with you?
Head over to julieholly.com. If you head there, you'll be able to access the Conscious Investor podcast, which will support you with learning more about investing. Also, we by the team that helps produce it, a mindset episode each Monday. So for 3.5 years, every single week, so there are over 400 episodes there waiting for you to go and grow. There's also a YouTube channel that's really helpful, and there's a playlist on the Conscious Investor YouTube channel that will just walk you through a lot of the terminology and little bite-sized nuggets. So you can check out this playlist. But I love supporting and educating people. And so if you are feeling like this is over your head, I felt that way too the first time I heard about syndication, and I was raised in real estate. So like it is a different space. Commercial is very different than what we're used to in the residential side. But I can assure you this. It's really simple and it's extremely strategic and advantageous to be involved in this type of investment. So, reach out, don't be a stranger. You can actually give me a call at 208 603 0996, or you can head over and schedule a time on my calendar.
Awesome. Well, Julie, this is super enlightening. Thank you so much for being generous with your time and sharing your knowledge with everybody. And yeah, I know you're not too far away from Coeur d'Alene, so we'll be seeing each other around, and look forward to continuing to chat with you and pick your brain.
Likewise, thanks so much, Chris. I appreciate it.
Thank you for your attention and listening to this episode of The Pursuit of Purpose. Your feedback and comments mean the world to me. If you liked what you heard, please take a second, leave me a 5-star review on iTunes. If you've got suggestions for future episodes or just want to say hi, shoot me an email at chris@chriskiefer.com. Don't forget, I make it a point to include all the links to the books, movies, and resources mentioned on this episode in the show notes. You can see those directly below in the description or on my website, chriskiefer.com. Thanks so much, guys.